In August 2002, 700 stores went dark in a single month. 30,000 people showed up to work and were told not to come back. No warning, no severance announcement on the news. Just signs taped to glass doors. Store closing, everything must go. Ames Department Stores was the fourth largest discount retailer in America. Bigger than Target was in 1988, bigger than most people remember. At its peak, it stretched across 29 states and served millions of working-class families who had shopped there for decades. And it didn't collapse because of a bad economy. It didn't collapse because of bad luck. It collapsed because the same men who built something great made the exact same catastrophic mistake. Twice, 11 years apart. The first time almost killed them. The second time finished the job. This is the story of how a company forgets who it is, how ambition without infrastructure becomes a death sentence, and in how an empire built for the little guy was ultimately destroyed by the people running it. Ames didn't fall, it jumped. In 1958, two brothers from Massachusetts looked at a map of New England and saw something nobody else was paying attention to. Not the big cities, not Boston, not New York, the small towns, the mill towns, the places where a family of four was stretching every dollar and the nearest department store was a 40-minute drive away. Milton Gilman and Herbert Gilman didn't have a revolutionary idea. They had a simple one. Open a discount store, keep the prices low, put it somewhere nobody else bothered to go. They opened the first Ames store in Rocky Mount, Virginia, a town so small most people in the next county hadn't heard of it. No fanfare, no ribbon-cutting ceremony covered by national press. Just a store, a parking lot, and a sign. And people came. Not because Ames was glamorous, it wasn't. Not because the store was beautiful, it wasn't that either. People came because Ames understood something fundamental about the American working class in the post-war era. They didn't want luxury. They wanted dignity at a price they could afford. The 1950s and 60s were boom years on paper. GDP was climbing. Suburbs were spreading. The American dream was being sold on every television set in the country. But the families buying frozen dinners and patching school clothes didn't live in the version of America that showed up in magazines. They lived in Ames country. And Ames country was everywhere, if you knew where to look. Through the 1960s, the company expanded quietly across the Northeast. Connecticut, Massachusetts, New York, New Hampshire. Each new store followed the same playbook. Find a secondary market, keep overhead lean, price aggressively, and stay out of the way of the giants. Kmart was expanding nationally. Sears was the undisputed king of middle-class retail. Walmart was a regional player down south, still figuring itself out. None of them were particularly focused on the same zip codes Ames was targeting. That wasn't an accident. It was the entire strategy. Don't fight where the big players are strong. Win where they aren't looking. By the mid-1970s, Ames had built something genuinely impressive. Not flashy, not famous outside the region, but profitable, disciplined, and deeply trusted by the communities it served. Customers didn't shop at Ames the way they shopped at a faceless chain. They shopped there the way they shopped at a store that felt like it belonged to their town. Managers knew regulars by name. The merchandise was practical. The experience was frictionless. Inside the industry, analysts were starting to pay attention. Ames was climbing the rankings of American discount retailers, not by making noise, but by executing quietly and consistently year after year. By the late 1970s, they were in the top tier of regional discount chains on the East Coast. Not a household name across the country, but in New England and the Mid-Atlantic, the red Ames logo was as familiar as the corner diner. That kind of brand loyalty takes decades to build. It takes far less time to destroy. By 1985, Ames operated well over 200 stores, all concentrated in a geography it understood deeply, all running on a model that worked. The balance sheet was clean. The growth was organic. The culture was intact. And then someone in the boardroom looked at a map again. This time, they weren't looking at the small towns nobody wanted. They were looking at everything else. There is a particular kind of success that doesn't make headlines. No IPO, no celebrity endorsement, no magazine cover, Just a company that shows up, does the work, and gets better every single year, quietly, methodically, without asking for applause. That was Ames through the late 1970s and into the mid-1980s. While Kmart was building massive stores in suburban shopping centers and Sears was anchoring malls from coast to coast, Ames was doing something that looked almost boring by comparison. It was refining, tightening, learning its customer better than any competitor in its lane. The strategy had a logic to it that only makes sense if you understand retail geography. Every major discount chain in America was chasing the same markets. High-traffic suburban corridors, dense population centers, interstate-adjacent real estate. The competition in those corridors was brutal. Margins were thin. The cost of winning customers was high. Ames didn't play that game. Instead, it owned the gaps, the secondary markets, the towns with one main street and a hardware store and not much else. Places where a discount retailer wasn't competing against three other discount retailers. It was the only option within 20 miles. In those markets, Ames didn't have to be the best. It just had to be there. And it was. That positioning wasn't just smart. It was a structural advantage that compounded year over year. Because in those communities, switching costs were high. If Ames was the only game in town, customers didn't comparison shop. They built habits. They brought their kids. Those kids grew up and brought their own kids. The brand loyalty Ames accumulated in these markets wasn't the transactional kind you can buy with a coupon campaign. It was the deep, almost irrational kind that comes from being woven into the fabric of daily life. By 1980, the company was operating across the Northeast with a consistency that was the envy of regional retail. Store formats were standardized. Supply chain was lean. Inventory management, for the era, was disciplined. The economics worked because the model was honest, low cost to operate, loyal customer base, minimal marketing spend, steady turns. Wall Street wasn't throwing a parade, but the numbers were real. Through the early 1980s, Ames continued its methodical expansion, always staying within markets it understood, always keeping the balance sheet in check. By 1985, the company had crossed the threshold into the top 10 discount retailers in the United States, a fact that surprised people outside the industry who had never heard of them. Inside the industry, it surprised nobody. The people who watched retail closely knew what Ames had built. They knew the unit economics were sound. They knew the customer relationships were genuine. And they knew that the Gilman brothers had constructed something rare in American retail. A business with a real identity. Not a brand identity in the marketing sense. An actual identity. A sense of purpose. A clear answer to the question every business eventually has to answer. Who are we and who are we for? Ames knew exactly who it was. A discount store for working people in places that bigger chains ignored. Simple, focused, effective. The irony, or it is a brutal irony, is that this clarity of identity was about to become the thing the company abandoned. Because by the mid-1980s, the boardroom had developed a new ambition. An ambition without discipline has a way of making people forget exactly what made them successful in the first place. The next move was already being planned, and it would change everything. In the summer of 1988, an opportunity landed on the desk of Ames leadership that looked, on paper, like the deal of a decade. Zayre Corporation, a Boston-based discount chain with roughly 400 stores scattered across the eastern United States, was looking to exit the retail business. Management had decided to spin off its discount division and focus on its specialty chains, TJ Maxx and Hit or Miss, which were performing well. The discount stores were bleeding, and Zayre wanted out. For Ames, the pitch was seductive. 400 stores, established locations, existing infrastructure. Overnight, a regional chain with a little over 300 stores could become a national player with more than 700. The numbers looked transformative. The scale looked decisive. The opportunity looked like exactly the kind of bold move that separates companies that stay regional forever from companies that become household names. The acquisition price was approximately $800 million. Ames didn't have $800 million sitting around. They borrowed heavily to make it happen. And that, before a single Zayre store was ever integrated, was the first mistake. But the debt wasn't even the real problem. The real problem was what Ames was actually buying. Strip away the headline number and look at what the Zare portfolio actually contained. These were not stores that had been neglected temporarily and were waiting for the right operator to unlock their value. These were stores in structural decline. The physical locations were aging. Many needed significant capital investment just to meet basic retail standards. The merchandise mix was inconsistent. The customer base was not loyal. It was transactional, price-driven, and already drifting toward competitors who were executing better. Zare's stores were also concentrated in a geography that was fundamentally different from Ames's core territory. Zare operated heavily in urban and dense suburban markets. Higher real estate costs, more competition, more demanding customers, faster-moving inventory cycles. These were exactly the kinds of markets Ames had deliberately avoided for 30 years. Not because Ames couldn't compete in them theoretically, but because Ames had never built the operational muscle to compete in them. Ames knew how to win in small towns. Zare lived in big ones. These were not the same game. The integration began in late 1988, and it unraveled almost immediately. Two separate IT systems, two separate supply chains, two separate store operating cultures. Ames stores ran lean and disciplined. Zare stores ran inconsistently, with local management practices that varied wildly from location to location. Trying to fold one into the other wasn't a process. It was an argument happening in 700 locations simultaneously. Inventory problems surfaced within months. Stores that were supposed to be restocked on Ames's disciplined schedule were receiving the wrong merchandise, or receiving it late, or not receiving it at all. Customers who had never shopped Ames before walked into converted Zare locations and found shelves that were half empty or stocked with product that made no sense for the neighborhood. The brand promise, the one thing Ames had spent 30 years carefully building, meant nothing to these new customers. And the old Ames customers in the company's original markets were beginning to notice that management's attention had moved elsewhere. Meanwhile, the debt service on the acquisition was relentless. Every quarter, hundreds of millions of dollars in interest obligations had to be met regardless of whether the integration was working, and the integration was not working. By 1989, the losses were accelerating. By early 1990, the situation was no longer recoverable through operational adjustments alone. On April 25, 1990, Ames Department Stores filed for Chapter 11 bankruptcy protection. It was front-page news in retail trade publications. An object lesson, commentators said, in the dangers of overreach. A cautionary tale about confusing size with strength. Within 2 years, Ames had closed the vast majority of the former Zare locations, shed billions in liabilities through the bankruptcy process, and emerged from Chapter 11 in 1992 as a smaller, leaner company. The Zare chapter was over, or so everyone thought. Here is what nobody said loudly enough at the time, and what the board of Ames apparently failed to internalize fully. The company had just spent 4 years being destroyed by a leveraged acquisition of a struggling retail chain with incompatible store locations, deteriorating assets, and a customer base that didn't match Ames's identity. They had survived it, barely, and in surviving it, they had learned something. The question was whether they had learned the right thing, because 11 years later, the same boardroom would face a remarkably similar opportunity, and they would say yes again. There is a moment in every institutional crisis where the people inside it still believe the situation is manageable. They run new projections. They hold emergency meetings. They talk about restructuring and right-sizing and strategic realignment. The language stays clinical because clinical language creates the illusion of control. If you can name the problem precisely enough, it feels like you're already halfway to solving it. Ames went through that phase in 1989. And then reality stopped cooperating. The numbers coming in from the converted Zare stores were not bad in the way that a difficult quarter is bad. They were bad in the way that signals a system failure. Store after store was underperforming against even the most conservative post-acquisition projections. Foot traffic in the former Zare locations was not stabilizing. It was continuing to decline. Customers who had already been drifting away from Zaire before the acquisition didn't suddenly return because the sign above the door now said Ames. They had moved on. And winning them back would have required a level of investment in store renovation, in marketing, in inventory quality, that Ames simply did not have the capital to deploy because the capital was already gone. The $800 million acquisition debt didn't pause while Ames figured out the integration. It compounded. Every month, the interest clock ran regardless of what was happening inside the stores. By mid-1989, Ames was caught in a bind that has destroyed stronger companies than it. To fix the Zaire stores, it needed money. To get money, it needed the stores to perform. The stores couldn't perform without the money. There was no exit from that loop through normal operations. The math had closed. Internally, the pressure was producing exactly the kind of organizational dysfunction that accelerates decline. Senior managers who had built their careers on the original Ames model, disciplined, lean, community-focused, were now being asked to execute a turnaround in markets they didn't understand, with tools they didn't have, on a timeline that didn't allow for learning. Some left. Others stayed and fought battles they couldn't win. At the store level, the human cost was immediate and visible. Employees who had transferred from Zaire locations didn't know the Ames system. Ames veterans who had been redeployed to struggling markets were demoralized. Customers could feel it. That particular atmosphere of a store that isn't quite sure what it is anymore, where the staff seems uncertain and the shelves tell no coherent story. In retail, atmosphere is not a soft metric. It is the product. When a store loses its sense of identity, customers stop coming. Not dramatically, not all at once. They just quietly find somewhere else to go. And each one they lose is harder to get back than the last. By early 1990, Ames was losing customers it had never actually won and hemorrhaging the ones it had spent decades earning. The board exhausted every conventional option: asset sales, credit renegotiations, operational cuts so deep they damaged the core business that was still functioning. None of it was enough to outrun the structural problem. Too much debt, too many bad stores, too little time. On April 25, 1990, the filing went in. Chapter 11, Reorganization. The legal language of a company admitting it cannot pay its bills as they come due. The bankruptcy proceedings were not quick or clean. They stretched across 2 years of negotiations with creditors, landlords, and suppliers, each group fighting to recover what it could from an estate that didn't have enough to go around. During that period, Ames closed approximately 74 of the worst-performing former Zaire locations. Thousands of employees lost their jobs in those closings. Communities that had watched a Zaire become an Ames now watched an Ames become an empty building. In 1992, Ames emerged from Chapter 11. Smaller, restructured. The debt load had been significantly reduced through the bankruptcy process. The worst stores were gone. The company that came out the other side was leaner than the one that had gone in, closer, actually, to the original Ames model that had worked so well for 3 decades. The trade press covered the emergence as a comeback story. Retailers quarterly noted the discipline of the restructuring. There was briefly genuine optimism about what Ames could become now that the Zaire weight had been cut away. And that optimism was not entirely wrong. Ames in the mid-1990s was genuinely stable, profitable in several consecutive quarters, operating with more focus than it had shown since before 1988. But here is the thing about surviving a near-death experience that nobody talks about enough. Survival feels like vindication, and vindication is one of the most dangerous feelings a leadership team can have. Because what Ames needed to take from the Zaire disaster was a permanent structural humility, a hard limit on the size of acquisitions it would ever attempt again, a written-in-stone rule about debt levels, a binding commitment to never again confuse opportunity with identity. What it took instead was a different lesson entirely. It took, we made it through, which means we can handle more than we thought. That misreading of its own history would cost Ames everything. The second mistake was already taking shape. And this time, there would be no Chapter 11 to survive. Coming out of bankruptcy in 1992 is not a triumphant moment. There are no celebrations, no press conferences with champagne. The company that emerges from Chapter 11 is a quieter, more cautious version of itself, carrying the institutional memory of collapse, operating under the watchful eye of restructured creditors, and rebuilding trust with suppliers who spent 2 years wondering if they'd ever get paid. Ames in 1992 understood all of that. For a while, it acted like it. The stores that remained after the Zaire purge were concentrated back in familiar territory. The Northeast, the secondary markets, the communities where the Ames name still meant something. The merchandise mix was rationalized. The supply chain was tightened. The operational discipline that had defined the company in its best years was deliberately reintroduced, almost like a company trying to remember who it used to be. And it worked. Through the mid-1990s, Ames posted consecutive profitable quarters for the first time since before the Zaire acquisition. Same-store sales stabilized. Customer traffic in the core markets held firm. The balance sheet, stripped of the catastrophic acquisition debt, began to breathe again. For approximately 5 years, Ames was exactly what it should have been: a well-run, profitable, regionally focused discount retailer with a loyal customer base and no illusions about its place in the national landscape. It wasn't exciting. Industry analysts didn't write breathless profiles about it. It wasn't the kind of growth story that generates investor enthusiasm or board-level ambition. But it was real, it was sustainable, and in an industry that was about to enter one of the most brutal competitive periods in American retail history, sustainable was worth protecting. The problem was the world outside Ames was not standing still. Between 1992 and 1998, Walmart transformed from a dominant regional player into something that had no real precedent in American commerce. Sam Walton had died in 1992, but the machine he built kept accelerating. Walmart's national store count exploded. Its logistics infrastructure, the distribution network, the satellite-linked inventory systems, the supplier relationships built on scale no competitor could match, created a structural cost advantage that widened every year. By the mid-1990s, Walmart wasn't just winning on price. It was winning on selection, on consistency, on the sheer reliability of the experience. Walking into a Walmart in Vermont felt identical to walking into one in Arkansas. That standardization, at that scale, was something no regional chain could replicate. At the same time, Target was executing one of the most successful brand repositioning campaigns in retail history. Where Walmart competed on pure price, Target was carving out a distinct identity. Design-conscious, slightly aspirational, the discount store where you didn't feel like you were settling. Target's private label partnerships, its store aesthetics, its deliberate curation of merchandise, all of it added up to a value proposition that was pulling customers upmarket from the traditional discount space. Ames watched both of these developments from its regional corner and had no clear answer to either one. It wasn't cheap enough to out-Walmart Walmart. It wasn't differentiated enough to out-Target Target. In the markets where it operated, it still had loyalty and familiarity working in its favor. But loyalty and familiarity erode when customers start noticing that the alternative down the highway has more selection, lower prices, and a cleaner store. By the late 1990s, the pressure on Ames's same-store performance was becoming measurable. Not catastrophic, not yet, but the trajectory was visible to anyone willing to read the numbers honestly. Inside the boardroom, two competing instincts were forming. The first was the instinct toward discipline. Stay the course, defend the core markets, accept a smaller footprint in exchange for durable profitability, and let the giants fight each other while Ames quietly served the customers they still reached. The second was the instinct toward scale, the belief that the only way to survive in a consolidating industry was to get bigger, that a regional chain of 300 stores could not generate the purchasing power or the overhead leverage needed to compete long-term against national players. The discipline instinct was correct. The scale instinct won. And in 1999, it arrived wearing a familiar disguise. Another struggling discount chain, another portfolio of stores at below-market prices, another chance to double the footprint overnight. Its name was Hill's Stores, and Ames had seen this movie before. It bought a ticket anyway. There is a concept in psychology called error repetition under stress. It describes a phenomenon where individuals and organizations, when facing pressure to perform, don't reach for new solutions. They reach for familiar ones, even when the familiar solution is the one that almost destroyed them before. The brain under pressure defaults to pattern, and pattern in an institution means doing what the institution already knows how to do, even if what it knows how to do is wrong. In 1999, Ames Department Stores acquired Hill Stores for approximately $1.4 billion in assumed debt and liabilities. The justification was logical on its surface. Hills was a Midwestern and Mid-Atlantic discount chain with approximately 155 stores operating in markets that were adjacent to Ames's existing territory. The stores had name recognition in their communities. The brand wasn't dead, it was just underperforming, the argument went, under management that hadn't invested properly. With Ames's operational discipline applied to Hill's footprint, the combined company would have over 700 stores, genuine national scale, and the purchasing power to compete for supplier terms that neither company could achieve alone. It was almost word for word the same argument that had been made for the Zayre acquisition 11 years earlier. Same logic, same assumptions, same fatal blind spots. The first blind spot was the condition of the assets. Hill's stores, like Zayre stores before them, were not hidden gems waiting for a competent operator. They were aging locations in competitive markets that had been underinvested for years. Many needed significant capital expenditure just to bring them to a baseline standard of operation. That capital expenditure was not factored into the acquisition rationale in any honest way. It was the kind of cost that shows up later, in the middle of an integration, when there is no longer an option to walk away. The second blind spot was the debt structure. Ames in 1999 was not a company with pristine finances. The years of disciplined operation after the Zayre bankruptcy had restored profitability, but they had not rebuilt the kind of balance sheet that could comfortably absorb $1.4 billion in new obligations. The Hills acquisition levered Ames back up to a debt load that left almost no margin for error. No cushion for a bad quarter, no buffer for an unexpected cost. No room to invest in the very improvements the acquired stores desperately needed. The third blind spot, and this one is the most damning, was the competitive environment. The Walmart of 1999 was not the Walmart of 1988, and that difference was everything. In 1988, when Ames bought Zayre, Walmart was a powerful but still expanding competitor. There were markets it hadn't yet fully penetrated. There were geographies where a well-run discount chain could still defend its position. The competitive landscape was brutal, but it had seams. By 1999, those seams were gone. Walmart had crossed 3,000 stores nationally and was generating over $130 billion in annual revenue. Its supply chain was the most sophisticated in the history of retail. Its prices were structurally lower than any competitor could match without losing money. The markets that Hill stores occupied, Ohio, Pennsylvania, New York, New Jersey, were markets where Walmart was already present, already dominant, and already extracting whatever margin existed for a mid-tier discount operator. Ames was acquiring stores in a battlefield where the war had already been decided. And then there was Target. By 1999, Target's transformation was complete. It had successfully repositioned itself as the aspirational discount option, the store where design-conscious, value-seeking consumers felt good about shopping. Target was pulling customers from the exact demographic that both Ames and Hills depended on. The middle of the market, the customer who wanted decent quality at low prices without the clinical bleakness of a bare-bones discounter, was being carved up by a competitor that had invested years and billions into understanding exactly what that customer wanted. Ames had no answer to Target. It had no private label strategy, no design partnerships, no brand identity beyond regional familiarity in competitive pricing. In a fight for the middle market consumer, Ames was bringing nostalgia to a branding war. The Hills acquisition closed in 1999. The integration began. And within months, the same problems that had surfaced after the Zayre deal were surfacing again. Systems incompatibilities, inventory disruptions, management culture clashes, underperforming stores draining cash from the stores that were still working. The people who had been at Ames through the Zayre disaster recognized the pattern immediately. Some of them said so. They were not loud enough. Or perhaps they were not listened to. because the decision had been made. The debt was on the books. The stores were open under the Ames banner. And the only direction available now was forward, into a competitive landscape that had no mercy for a company carrying this much weight with this little runway. Ames had made its bet. The table was already turning against it. By the year 2000, the American discount retail landscape had sorted itself into a brutal hierarchy. At the top, Walmart, untouchable, structurally advantaged, operating at a scale that made competition not just difficult, but mathematically irrational for anyone trying to match it dollar for dollar. Walmart in 2000 was not a retailer in the traditional sense anymore. It was a logistics company that happened to sell merchandise, and the gap between its cost structure and everyone else's was widening every single quarter. Directly below it, Target, clean stores, smart branding, a customer experience that felt intentional rather than accidental. Target had spent the better part of a decade building something that Walmart couldn't replicate, a sense of style, of curation, of shopping as a mildly pleasurable experience rather than a pure utility transaction. Target wasn't beating Walmart on price, it was beating it on identity. And identity in a crowded market is worth more than most operators understand until it's too late, and then somewhere further down, the rest of the field. Kmart struggling with its own identity crisis, dollar stores multiplying rapidly and eating the bottom of the market, regional chains trying to defend territory that was shrinking every time a new Walmart supercenter opened within driving distance. Ames sat in that lower tier, carrying $1.4 billion in Hill's acquisition debt, managing 700-plus stores across a geography it didn't fully control, competing against two companies that had already won. The operational problems from the Hills integration were not resolving. They were settling into the business like a chronic condition, not dramatic enough to force an immediate crisis, but persistent enough to drain performance quarter after quarter. Inventory management across the combined store base was inconsistent. The technology infrastructure was a patchwork of legacy systems from three different corporate histories. The original Ames platform, remnants of the Zaire conversion, and now the Hills systems layered on top. Getting accurate real-time inventory data across 700 stores was not a minor challenge. It was a fundamental operational handicap in an era when Walmart was making real-time supply chain visibility a core competitive weapon. Store-level execution suffered as a result. Products that customers wanted were out of stock. Products that customers didn't want were taking up shelf space. The retail experience in too many Ames locations had the particular quality of a store that is being managed reactively rather than proactively. Always catching up, never quite ahead. And the customers noticed. Same-store sales figures through 2000 told the story clearly. Traffic was declining in the markets where Ames faced direct Walmart competition. The Hills stores, which had been underperforming before the acquisition, were not recovering on the timeline the integration plan had projected. The stores in Ames's original Northeast core, the ones that had been profitable through the mid-1990s, were holding, but the margin they generated was being consumed by the losses elsewhere in the system. The company was running on the fumes of its own best assets to keep its worst assets alive. Then the external environment delivered two blows that removed whatever remaining cushion existed. The first was the broader economic slowdown of 2001. The dot-com collapse had been unwinding since 2000, eroding consumer confidence and pulling back discretionary spending. The effect on discount retail was uneven. Pure value players like Walmart actually benefited as consumers traded down. But mid-tier discounters like Ames, competing on neither the lowest price nor the best experience, found themselves squeezed from both directions simultaneously. The customers who were tightening their budgets were going to Walmart. The customers who still had discretionary income were going to Target. The middle was hollowing out. The second blow came on September 11, 2001. The immediate shock to consumer spending following the attacks was severe and national. Retail traffic collapsed in the weeks following. For a company with Ames's debt load and cash position, weeks of sharply reduced revenue were not an inconvenience. They were an emergency. There was no liquidity buffer to absorb the shock. Every day of reduced sales translated directly into a deteriorating ability to meet financial obligations. Ames issued a series of increasingly grim financial disclosures through the fall of 2001. Creditors who had been monitoring the situation closely began tightening terms. Suppliers, always the most sensitive early warning system in retail distress, began adjusting their willingness to extend favorable payment arrangements. The signals were unmistakable to anyone reading them honestly. This was not a company navigating a difficult period. This was a company running out of road. The board explored options, asset sales, restructuring conversations with lenders. The possibility of a Chapter 11 filing that might, as it had in 1990, allow the company to shed its worst liabilities and emerge smaller but viable. But 1990 was not 2002. In 1990, there had been a core business worth saving, a set of stores in markets with genuine loyalty, operating a model that worked when it wasn't being crushed by acquisition debt. By 2002, that core had been eroded by 3 years of underinvestment, management distraction, and competitive pressure from two companies that were not going to slow down and wait for Ames to find its footing. There was nothing left to reorganize around. The end was no longer a possibility, it was a schedule. On August 14, 2002, Ames Department Stores filed for Chapter 7 bankruptcy protection, not Chapter 11, not reorganization, not a structured process designed to shed debt and emerge leaner on the other side. Chapter 7, liquidation, the legal term for it's over, the distinction matters. Chapter 11 is a bet that the underlying business has value worth preserving, that with the right restructuring, the right asset sales, the right negotiated relief from creditors, something viable can survive. Companies file Chapter 11 when they believe they have a future that is simply being blocked by a present they can't afford. Chapter 7 is a different calculation entirely. Chapter 7 is filed when there is no future to protect, when the assessment, by management, by creditors, by the lawyers who have looked at every available option, is that the business cannot generate enough value, even under the most optimistic scenario, to justify the cost of keeping it alive. Ames filed Chapter 7 because everyone who looked at the numbers reached the same conclusion. There was nothing left to save. The announcement hit the retail industry with the particular weight of an ending that had been coming and still managed to land hard. Ames was not a minor player. At the time of the filing, it operated 327 stores across 19 states, the remnant of a portfolio that had once stretched to over 700 locations following the Hills acquisition. Tens of thousands of people went to work at those stores every day. Millions of customers had been shopping in them for decades. And now, in a single filing, all of it was scheduled for termination. The liquidation process began immediately. Liquidation in retail has a specific visual grammar that anyone who lived through it remembers. The signs appear first. Large yellow or orange banners stretched across storefront windows. Store closing. Everything must go. All sales final. The language is blunt in the way that only commercial endings can be blunt, stripped of any softening euphemism. Inside the stores, the experience was disorienting. Merchandise that had been carefully arranged on shelves according to planograms and corporate visual standards was now simply inventory to be converted to cash as quickly as possible. Liquidation companies, specialists in the particular science of extracting maximum recovery value from dying retail, took over store operations. Prices dropped, then dropped again. Shelves emptied and were not restocked. The physical spaces began to look hollowed out, which they were. Customers came, not the way they had come for decades, habitually as part of a routine, because Ames was simply where you went for certain things. They came the way people come to liquidation sales, opportunistically, to pick through what remained, to buy things they may not have needed at prices that reflected the desperation of the seller. For longtime Ames shoppers, people who had been walking into these stores since the 1960s and 1970s, who had bought back-to-school clothes here, and holiday gifts here, and household basics here for 30 years, the experience carried a particular grief, not dramatic grief, not the kind that announces itself, the quiet kind, the kind that comes from watching something familiar disappear and realizing it isn't coming back. 30,000 people lost their jobs. That number is worth sitting with for a moment. 30,000, not an abstraction, not a line item in a bankruptcy filing. 30,000 individuals, store managers, department leads, cashiers, stockroom workers, maintenance staff, who showed up for their shifts and were handed information about the liquidation process instead of a work schedule. Many of them had been with the company for years, some for decades. The institutional knowledge, the customer relationships, the quiet professional pride of people who were genuinely good at their jobs. All of it dissolved simultaneously. The final Ames stores closed in late 2002. The red signs came down. The parking lots emptied. The buildings, some of them purpose-built for Ames decades earlier, some converted from other retailers, some that had been Zayre stores before they were Ames stores, sat vacant. Commercial real estate brokers began the process of remarketing them to whoever came next. Some became Walmart locations, some became Targets. The particular irony of that outcome requires no elaboration. Some became dollar stores, some sat empty for years, the particular kind of blight that a vacant big box building creates in a small community. A large useless structure that is too expensive to repurpose and too visible to ignore. The Ames name disappeared from the American retail map entirely. No successor brand, no licensing arrangement, no nostalgic revival, just absence. The specific absence of something that had been present for 44 years, and then, in the space of a few months, was simply gone. 44 years, gone in one filing. The company that had started in a small Virginia town in 1958, built on the simple idea that working people in overlooked places deserved a decent store, ended not with a fight, not with a final attempt at reinvention, but with the quiet administrative machinery of liquidation, processing its remaining assets, and distributing the proceeds to creditors who recovered pennies on the dollar. There was no eulogy, no ceremony, no final message from leadership to the employees who had given careers to the brand. Just the signs on the windows, and then eventually not even those. When a company the size of Ames collapses, the instinct is to find a single cause. A bad CEO, a wrong acquisition, a market that turned. One decision, one moment, one person who made the call that broke everything. The single cause narrative is satisfying because it is clean. It gives us something to point at. It tells us that if we avoid that one thing, we will be safe. The problem with Ames is that the single cause narrative doesn't hold. Because Ames wasn't destroyed by one mistake. It was destroyed by a pattern. A set of institutional behaviors that repeated themselves across 4 decades with remarkable consistency, each time producing a version of the same outcome, each time leaving the organization less equipped to survive the next iteration. Understanding that pattern is the only honest way to understand what actually happened. The first element of the pattern was the confusion of scale with strength. Every time Ames faced competitive pressure, in the late 1980s with the rise of national chains, in the late 1990s with Walmart's dominance and Target's ascent, its response was the same. Get bigger, acquire stores, expand the footprint. The underlying assumption was that size would generate the advantages needed to compete. Better supplier terms, lower per unit costs, greater marketing leverage, more relevance in the national conversation about retail. But scale and the strength are not the same thing. Scale is a number. Store count, revenue, square footage. Strength is operational. It lives in the quality of execution, the coherence of the customer experience, the reliability of the supply chain, the clarity of the brand identity. Walmart's scale was formidable, but what made Walmart dangerous was the strength underneath the scale. The logistics infrastructure, the technology investment, the supplier relationships built over decades of disciplined negotiation. Ames pursued scale without building the strength to support it. Twice. And twice, the scale it acquired became a liability rather than an asset. Too many stores, in too many wrong markets, consuming capital that the core business needed to defend itself. The second element was the misreading of survival as validation. Coming out of the Zayre bankruptcy in 1992 should have produced a permanent institutional reckoning. The near-death experience should have encoded a hard limit, a structural prohibition against leveraged acquisitions of struggling retailers, written into the company's strategic framework with enough force to survive changes in leadership and changes in board composition. It didn't. Instead, survival was interpreted as resilience. The company had gone through the fire and come out the other side. That experience, rather than generating permanent caution, generated a quiet confidence that the organization could handle more than the conventional wisdom suggested. When the Hills opportunity appeared in 1999, that confidence was in the room. It shouldn't have been. The third element was the absence of honest competitive assessment. At no point in the late 1990s does the available record suggest that Ames's leadership conducted a genuinely honest analysis of what competing against Walmart and Target in 2000 and beyond would actually require. The acquisition rationale for Hills was built on assumptions about post-integration performance that had no credible basis, not given what the Zaire experience had demonstrated about integration timelines, not given what the competitive environment was clearly communicating about margin compression in the discount sector. Honest competitive assessment would have produced a different conclusion. It would have shown that the markets Hills occupied were markets where Walmart was already structurally dominant. It would have shown that the capital required to bring Hills stores to a competitive standard was not available. It would have shown that the combined entity, carrying $1.4 billion in new debt, had almost no tolerance for the execution shortfalls that every large integration inevitably produces. That analysis was either not done or not heard. The fourth element, and perhaps the most instructive, was the erosion of identity without a replacement. The original Ames had a clear answer to the question every business must eventually answer. Who are we and who are we for? It was a discount store for working people in overlooked markets. That identity was not a marketing slogan. It was an operational philosophy. It told the company which stores to open, which markets to enter, which customers to serve, and, critically, which opportunities to decline. The Zaire acquisition violated that identity. The Hills acquisition confirmed its abandonment. By 1999, Ames was no longer operating from a coherent sense of purpose. It was operating from momentum and obligation. The momentum of being a large company that needed to keep growing, and the obligation of debt that demanded performance, regardless of whether the underlying strategy made sense. A company without a clear identity cannot make good decisions under pressure, because good decisions under pressure require knowing what you are optimizing for. When that is unclear, decisions get made on the basis of short-term financial logic, competitive anxiety, and the particular human tendency to believe that more is always better than less. Ames believed that until the end. Compare it directly to Walmart. In the same period that Ames was destroying itself through acquisition, Walmart was expanding aggressively, but on the foundation of systems it had spent decades building: the distribution centers, the satellite inventory network, the supplier partnership model, the culture of operational discipline that Sam Walton had installed as the non-negotiable core of the company. Walmart's scale worked because the infrastructure underneath it was real. Every new store opened into a system that was already functioning. The expansion reinforced the strength rather than straining it. Ames expanded into a system that was already struggling. Every acquisition added stores that needed to be fixed to a company that didn't have the resources to fix them. The expansion strained whatever strength remained until there was nothing left to strain. That is not bad luck. That is not an unforeseeable market shift. That is a leadership failure, sustained, repeated, and ultimately terminal. 30,000 jobs, 44 years, gone. Not because the market was cruel, because the institution forgot what it was, and then borrowed $1 billion to become something it was never equipped to be. Drive through certain towns in New England today and you will still find them. Large rectangular buildings set back from the road, surrounded by parking lots that are too big for whatever currently occupies them. A dollar store in one corner, a discount furniture outlet in another, or nothing at all, just cracked asphalt and faded line markings stretching across a space that was designed for a different volume of human activity than it now receives. These are the bones of Ames, not memorialized, not marked, just present in the way that old foundations are present, underneath whatever came after, shaping the land without announcing themselves. The communities that lost Ames stores in 2002 didn't get press coverage about their grief. The story that year was the bankruptcy filing, the creditor negotiations, the financial mechanics of liquidation, the human geography of the loss, the towns where Ames had been the anchor of a small commercial district, the neighborhoods where 3 generations of the same family had bought their back-to-school clothes in the same building. That story didn't fit neatly into a business news narrative. But it was real. Retail is infrastructure, not in the way that roads and bridges are infrastructure, in the quieter way that shared spaces are infrastructure, the places where a community gathers regularly, where strangers become familiar faces, where the rhythm of ordinary life gets conducted. When that infrastructure disappears, something in the texture of daily life changes. Not dramatically, not in a way that produces visible protest, but in the way that absence changes things, gradually and then permanently. The former Ames employees dispersed into an economy that was not particularly welcoming in 2002. Some found comparable retail positions. Many took significant pay cuts. Some left retail entirely. The institutional knowledge they carried, the accumulated understanding of how to run a store, manage a floor, read a customer, execute a seasonal transition, evaporated from the company when the company ceased to exist, because there was no company left to carry it forward. Inside business schools, Ames found a different kind of afterlife. The dual acquisitions, Zaire in 1988, Hills in 1999, became case study material for courses on M&A strategy, retail management, and organizational behavior. The Ames story is taught alongside other canonical retail failures as an illustration of specific, identifiable errors that can be studied, named, and theoretically avoided. Theoretically. Because here is the uncomfortable truth that the case study format tends to obscure. The people who made the decisions at Ames were not fools. They were experienced retail executives operating with the information available to them under competitive pressure that was genuinely intense, trying to solve a real strategic problem. How does a regional chain survive in a market that is consolidating around 2 national giants? The answer they chose was wrong, but the question was legitimate, and the forces that pushed them toward the wrong answer, the pressure to grow, the optimism bias of post-bankruptcy survival, the human tendency to believe that this time the circumstances are different. Those forces are not unique to Ames. They are present in every boardroom, in every strategic planning cycle, in every organization that has tasted success and is trying to figure out how to hold on to it, which is why Ames is still worth talking about. Not as a cautionary tale about discount retail specifically. As a mirror, look at Bed Bath & Beyond, a retailer with genuine brand loyalty and a defensible niche that spent its final years executing leveraged buybacks and chasing a transformation it didn't have the operational foundation to deliver. Filed Chapter 11 in 2023, gone by the end of that year. Look at Sears, once the defining American retailer, destroyed over decades by financial engineering, real estate maneuvers, and a leadership philosophy that treated the retail operation as a vehicle for extracting value rather than creating it. Look at any number of companies currently carrying debt loads that leave no margin for error, in competitive environments that are not becoming more forgiving, managed by leadership teams that are one bad acquisition away from the same conversation Ames's board was having in late 2001. The specific details change. The pattern does not. Ames was born to serve people that bigger companies ignored. That original purpose was clear, honest, and economically sound. It generated 40 years of genuine value for the communities it operated in and the employees who built careers inside it. It was abandoned, not all at once, not through any single act of conscious betrayal, but gradually through a series of decisions that each made a certain kind of sense in isolation and collectively added up to a company that no longer knew what it was for. That is the real lesson, not the debt ratios, not the integration timelines, not the competitive positioning frameworks. The real lesson is that identity is not a soft asset. It is the hardest asset a company has. It is the thing that tells you which opportunities to take and which to decline. It is the thing that keeps an organization coherent under pressure. It is the thing that once lost cannot be recovered through acquisition or restructuring or any financial instrument ever devised. Ames lost it, and then it lost everything else. The parking lots are still there. The stores are not. And somewhere in that gap, between the infrastructure that outlasted the institution, is everything you need to understand about what it costs to forget who you are.